Let's calculate the stock price for Canadian National Railway. So first we need the market cap, which is 84.2 billion. And now the stock price 118.6. So to get the shares outstanding, you just take the market cap divided by the stock price and you get 710 million shares outstanding. Next is free cash flow. And the best way to calculate the stock price for a company is to estimate future free cash flow and discount that number back to today's dollars. And that's what we're doing in this model. And we take 4 years of that data. And next is the income statement, and we need net income. So everything looks pretty good so far. No negative numbers. And then we need revenue. Okay, now we need to look at the capital structure of CNR, and to figure out the discount rate we need to apply to the future cash flows. So the interest they pay on their debt is 538 million. And the debt is 1.9 billion. And the long-term debt is 11.9 billion. And the interest they pay on the debt is 3.9%, but interest is tax deductible. So let's find out their effective tax rate. So the income before tax is 5.4 billion, and the income tax is 1.2 billion. So the effective tax rate is 22%. So the cost of debt is 3%. And now the cost of equity, we have to just find the beta. That's in Yahoo also, 0.64. That's a really low beta. That's a volatility of the stock. That indicates the stock is not volatile at all. And the cost of equity is 7.24%. And equity is more expensive than debt, as you can see, because equity sits lower on the capital structure of a company. So in the event of a default, debt holders get paid before equity holders. And the WACC is 6.64%, and the WACC is the weighted average cost of capital, which is a blend of the equity and the debt. And that's what we have to discount the future cash flows by. So we calculated 4 years of future free cash flow, and then we did a terminal value, which is all the years beyond year 4, and then we discounted those numbers back to today's dollars. And the value of the company is $70 billion divided by 710 million shares. So we calculate a stock price of 98.27, and it's trading at 118. So this is considered a sell because it's trading at a 21% premium. Let's see where it was trading at the past few years. So was it ever trading at 98? I guess maybe a year ago it was, but it's really close to intrinsic value, because a stock can trade well above or below intrinsic value. It's just really supply and demand of the market. And if you do your research, you'll definitely find some analysts saying this stock's a buy, and you'll see other analysts saying this stock's a sell. But each analyst has their own model and their own opinions. This is my model and my opinion. So thanks for watching.